Today we'll be looking at the Quant Mutual Fund. A lot of people have asked, should we be investing into Quant Mutual Fund because it has given us stellar returns. Some of Quant's schemes which have given returns as high as 50% above the index. So you looked at Quant Small Cap Fund and Quant Tax Saver, they've beaten the benchmark index by as much as 50%. And a lot of people are lining up to actually invest into these schemes. So if you want to invest into Quant Mutual Funds and want to understand why they're generating these high returns, what is their investment philosophy, I suggest you see the entire video. From where did Quant Mutual Fund start? So Sandeep Tandon is the CEO and the Chief Investment Officer. Their journey started in 2018. They acquired Escorts Mutual Fund. So Escorts group had mutual fund, but they were actually not doing much with it. The AUMs were around 100 to 200 crores. Quant actually started by acquiring this fund house in 2018, and up till 2020, March 2020, their AUMs were only 130 crores. But because their returns have been so good, because of their unique investment philosophy and the approach to investment, which is a bit different in terms of that they're looking to time the market based on what the macro environment is saying, their returns actually have been very good. And people have flocked to this, and their AUMs have actually increased from 130 crores to almost as high as 10,000 crores up till last month. Let's take a deeper dive into Quant Mutual Fund to understand what they're doing right and how are they investing and whether you should be investing in their funds or not. If we see the returns of their mutual fund schemes, so we have the Quant Active Fund that has beaten the benchmark by 30%. The Quant Focus Fund has beaten the benchmark by 16%. The Quant Large Cap and the Mid Cap Fund has beaten the benchmark by 1%. And we have the Quant Mid Cap Fund, which has beaten the Nifty Mid Cap by 14%. The Quant Small Cap Fund has beaten it by 51%. And the Quant Tax Plan has beaten the index by 55%. So you've seen consistently that they've actually beaten the benchmark by a considerable margin. It's not 1 or 2%, it is a significant percentage they've beaten the market, the benchmark by. So that's why people are getting interested into this fund house and investing more and more amount. So let's go in deeper and try and understand what is exactly happening on some of these funds and what is the investment philosophy they're following. So Quant Mutual Fund believes that it is a dynamic world, and due to changes in technology and the volatility in the markets, passive investment returns are going to underperform alpha investors, and they're trying to use technology and number crunching and trying to understand the macro environment better and try and generating alpha by timing the market to some extent. By timing, they do not mean timing on a daily basis, but they're trying to capture the flow of money moving from one asset classes to the other and moving from one country to the other, and trying to time that money flow which is happening and generate a better return in sectors and in emerging markets in India. So when you have this investment strategy, I don't think so that debt funds should you should be looking at. You should be looking more at a multi-cap fund, not at a large cap fund, but a mid-cap and a small cap funds, which are free and they let fund manager generate alpha. Let's look into one of their major funds, which is the Quant Active Fund. The investment principles which Quant Mutual Fund House follows is, so they look at data very seriously and they measure that data. They measure what is the valuation, what are the risk parameters. By valuation, they do fundamental analysis. So if the market is overvalued, undervalued. So if you look at like March 2020, they say the market had corrected, so it's extremely undervalued. Now from a risk perspective, are the businesses taking risk or not? Or the money which they're investing, are people looking at taking more risk or less risk? So in March 2020, when the corona happened, it was like a one-off event, and obviously no one's looking at investing money at that point of time. They're more worried about their life, so they're not investing at all. Third is the liquidity. There was ample liquidity. All the central banks had opened the lockers and they were giving money out free all over the world, in Europe and the US and in Japan. So most of the central banks reduced interest rates considerably at that point of time. So there was ample liquidity. So that kind of scenario where risk-taking ability has almost died is only going to go up, and there's ample liquidity made a case as per them for the markets to go up. So they understood the macro situation at that point of time. So they're using these parameters, as Sandeep has mentioned in some of his interviews. That's how they're using to understand the macro environment in investing. They believe that a person's experience is very important. They obviously want to use his experience. Apart from the numbers, they want the fund managers to use the experience which he's gained over 15-20 years and apply that along with the numbers. They follow something called a multi-asset, multi-manager approach. Means that they have 4-5 fund managers who are running 10 schemes, 8 schemes together, and the collective experience comes together, and they take investment decisions based on that. Apart from that, they're looking at how money is flowing from one asset class to the other, right? And very importantly, they're looking at how do we time the market in terms of how the money is flowing out of these asset classes and from one asset to the other, and trying to time the market and trying to time sectors and investing. So this is what they mean by timing, and not by day trading like an intraday trading, or timing the market looking at technical analysis or etc. So this is what they've done. So it's a data-driven approach along with some subjectivity which comes in from fund managers, and it has worked well for them at this point of time. So when we look at, if we dwell deeper and we look at the Quant active fund, if you see there what their portfolio was there in March 2020, and it has changed over a period of time considerably till March 2021. So you've seen a big changes in their portfolio. Their stocks are not the same. So there's a very high churning which is happening, almost 5 to 8 times higher than other fund managers in the same scheme category. So they're actually churning their portfolio more. That means they're investing from one stock to the other. What they're doing exactly, that they've not disclosed on as to how they are selecting this company, because they're looking at a macro view and looking at a fundamental analysis as well. But their portfolio hasn't changed to a very large extent from the last 1 year. So if you're looking at from something like September 2021 to September 2022, their stocks have changed much higher than other fund managers in a similar category. But compared to how much churning was happening in the previous year, that same churning has not happened in the next 1 year. Apart from this, something which you need to understand is how are they showing how they've generated these returns. Because their AUMs were 130 crores. So you have to understand, wherein your AUMs are smaller, it is easier to generate returns, right? So because it's a small amount of money which can be invested very aggressively, or it's easier to generate money or higher returns from a small amount. But when your asset size becomes big, it is much difficult to generate a similar percentage returns. So that is something which we also need to understand, because their AUMs only have increased in the last 1 year. So this is something which we need to understand, is how they are giving that, okay, the schemes have generated these many returns. Is it weighted average returns? Because the money is flowed in after March 2020, post which the bull run actually has started. So has this pot of money not seen the bear phase, and has this pot of money only seen the bull phase? And second, as they've shown a higher return, more money has flown in, and that part of money has only generated a bull run since then. So that is something which you have to analyze. Probably a good parameter would be to see the funds return after a period of 10 years, where they've seen good cycles in the entire market. We've seen the ups and downs, different asset classes, commodity cycles, everything we've seen. And then this fund house kind of has time tested itself. So since 2018, they've done well, but none of their schemes are more than 4 years old. This is something which we need to understand when we are investing into Quant Mutual Fund. When you're investing into their schemes, because their approach is so alpha driven, their decision making is based on timing. I think you should invest into mid caps over here, into small caps here, which are dependent on an asset manager who's taking the risk and the pain to generate an extra alpha, and in the multi-cap fund, which is a quant active fund. I would not look at this mutual fund to invest into a large cap fund. I will not look at this fund house to invest into their liquid fund or their debt plans, because for the extra 1% return, I don't want my fund manager to take risk in a liquid fund, and the motive of the liquid fund is not to take risk. Its motive is obviously to generate a certain return which is risk free by nature. A very important thing which I would like to add over here is the fund house uses something called VLRT. V stands for valuations, right? So fundamental valuations, they give 1/3 weightage. They look at something called liquidity. What are central banks doing? Are they trying to suck out liquidity from the market or not? And they look at something called risk appetite. So they look at parameters. They give highest weightage to apparently Bitcoin. So Bitcoins, which is kind of a global risk indicator for them. So they look at what are the Bitcoin prices are at this point of time and trying to assess what is the risk appetite of people right now. So if you've seen, Bitcoins have actually corrected from 69,000 in November 2021 to almost 20,000 at this point of time. So the risk appetite of people actually is much lesser at this point of time. And as you've seen, money is moved into bond markets because they're relatively safer. This is how they're gauging risk appetite. And the T stands for timing. So based on what is the behavior in the market right now, they time their exit and entries into stocks and into sectors. In fact, their factual framework which they've developed, it actually works well. So they give out an outlook based on their framework in their fact sheet, and you can actually go ahead and read it. It's very interesting to actually get a picture of what the macro picture is in the market right now. So it's a good framework which is doing well. Interest rates are higher, people want to generate a higher return. So a lot of money which is flowing into private markets is actually at an all-time high. And similarly in India, people are more interested in alternative investment strategies as well. So the Quant fund, being a mutual fund house, has come out with a strategy which is different from other fund houses, and hence people are actually interested in something which is giving them a higher return and looking at investing in a different way. So I would suggest that you do put some of your exposure into these funds and see how the market plays out for them and for you. So if you've liked our video, please hit the like button, subscribe to our channel, and hit the bell icon so you can get our future video notifications.